Warren Buffett is a famous American investor who has generated remarkable returns over the past 60 years, and there's a high chance you know who he is. Recently, he's been building a massive cash position at Berkshire Hathaway before stepping down as CEO. This signals that he doesn't see any stocks worth buying among those available to him. Berkshire has become so large that they can only acquire or invest in huge companies, otherwise, it won't move the needle. So, what if Warren Buffett were to start over from $0 today? What stocks would he likely want to buy to generate those remarkable returns he's achieved in the past? Well, to find out, we had to look at Warren Buffett's investing strategy as it's what has generated those fine returns. I've broken this approach down into 5 key principles. First, invest in companies you understand. Buffett has a rule of thumb: you should be able to explain what the company does or why you're buying it for at least 2 minutes straight. If you can't do that, don't invest in the company. So, if we want to find stocks Warren Buffett would buy, we need to understand his circle of competence, or in simple terms, the kind of businesses he understands well. These are simple, predictable businesses like consumer goods, financial institutions, insurance, and services that have been around for a long time and are likely to remain far into the future. Second, the company needs to have a moat. This is something Buffett strongly emphasizes as it's the key factor that helps a company survive and thrive over the long term. So, what defines a moat? A moat is essentially a company's competitive advantage, or in other words, its edge over the competition. Third, Buffett places a lot of value on strong management, specifically leaders who can allocate capital effectively. This means they know how to reinvest money wisely within the business and for its own future growth. Ideally, the management team should also have skin in the game, meaning they own more than 2% of the company or have a significant portion of their net worth invested in it. This is crucial because it ensures that management shares in the company's risks. And naturally, they'll want the company to perform well over time. Fourth, Buffett looks for companies that are trading at a fair or undervalued price relative to their intrinsic value. He believes that no matter how great a company is, it only makes sense to invest if the price is right. This principle is often summarized by one of his famous quotes: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett determines a company's intrinsic value by analyzing its future cash flows and discounting them to their present value. And this is called a discounted cash flow analysis, which we are going to use to evaluate the companies that Buffett would likely buy today if he had $0 to his name. Now, if the stocks is trading significantly below their intrinsic value, it provides a margin of safety, which reduces the investment risk. Fifth, Buffett looks for generally high quality companies that check all the boxes we've discussed so far and more. These companies typically have low levels of debt, a bright future, and are either part of a growing industry or possesses something unique that allows them to grow within their current market. When a business has these qualities, it becomes hard for it to fail, even with poor management. If the business model is strong and the way the company operates is smart, it can still go a long way. Now that we know what Warren Buffett would look for when evaluating companies, we can take a closer look at the 3 stocks that, based on these 5 principles, I believe he would be most likely to buy today. If we were to apply these principles in a stock market screener, we'd get 18 results. These are based on criteria like a debt to equity ratio between 0 and 1, a price to earnings ratio between 1 and 20, a price to free cash flow ratio between 1 and 20, and a market cap between 250 million and 5 billion. And lastly, a return on investment capital of at least 10%. Next, let's consider which sector Warren Buffett would likely focus on. These include retail, finance, and consumer goods. One stock that immediately comes to mind is NMI Holdings, which operates in the insurance industry, an area Buffett has historically favored. That already checks off the first principle: it's a business he understands well. The next question is, does the company have a moat? To keep it simple, let's ask ChatGPT. Alright, this does seem interesting. First of all, I would say that the company has a massive moat, but the insurance industry is still tough for new competitors to break into. Despite that, NMI Holdings maintains a default rate under 1% in the mortgage insurance sector, which is reportedly very good. They're also investing in the future, which is more of a growth indicator than a moat, but still a strong positive. So overall, this company definitely looks promising. Third, Buffett wants management to have skin in the game and be able to allocate capital well. We can tell if they're good at allocating capital by looking at their return on invested capital. ROIC, which shows how well they invest and earn returns. This company has a 5 year average return on investment capital of 13.6%, which is pretty good. The management owns 13.83%, which is great and definitely above the 2% ownership we like to see. Fourth, the company needs to be undervalued according to the discounted cash flow model. Using a 5% growth rate over a 10-year forecast, a 9% discount rate, and a 20% margin of safety, we arrive at an intrinsic value of $3.28 billion. Divide that by the number of outstanding shares, gives us a price of $42 per share, which is just slightly above the current market price. So overall, this stock looks very interesting and could definitely be something Warren Buffett would want to examine more closely. The second stock that seems like something Buffett would buy isn't actually on our screener list. It's one I've personally chosen. When it excludes certain industries from the screening, Korn Ferry stands out as a good pick. It's a consulting firm specializing in executive recruitment, leadership development, and talent management. What makes this company interesting is, first of all, its numbers. It has a price to earnings ratio of 13 and a price to free cash flow ratio of just 11. According to ChatGPT, Korn Ferry has built a decent but challenged moat. It has a strong brand in the executive search and consulting industry, and its broad range of services and global presence give it a competitive edge. However, the industry is competitive, so its moat may be considered narrow, relying heavily on its reputation and client relationships. When it comes to the management, they do have skin in the game with 1%. Now, hold on, that's not above the 2% we usually like to see, right? Yes, that's correct. But the CEO has 15.8% of his total net worth invested in the company, which shows he probably cares a lot about what happens to it. The company is also good at allocating capital with a 5 year average return on investment capital of 12.4%, which is pretty solid. Lastly, how does the stock trade compared to its intrinsic value? If we assume an 8.5% CAGR, the projected industry growth, that suggests plenty of room for the company to grow in the future. Using a 9% discount rate, a 10-year projection, and a 20% margin of safety, we arrive at a share price of $102 per share. And this is cheap compared to the current share price of just $70 at the time of recording this video. So this might actually be a stock that Mr. Warren Buffett would take a close look at, and something we probably should too. As you've seen, a lot of this data comes from ChatGPT and other sources that might not always be 100% reliable or accurate. That's why the sponsor of this video is EODHD. They provide high quality, trusted financial data that's extremely accurate. Instead of browsing through countless websites, you can use their API directly in Excel, Google Sheets, or even within a script. I definitely recommend checking that out. The link is in the description. Thank you so much for watching. None of this is financial advice, but you might have noticed that finding these companies isn't easy, even when you know what Warren Buffett looks for. So if you want a deeper dive into how to find cheap companies with potential for strong long-term results, watch this video right here.